You know that feeling, right? You open your banking app and there it is, a nice fat number staring back at you. Maybe you've been saving for years. Maybe you've skipped vacations, brown bagged lunches, told yourself no 1,000 times, and now you've got a pile of cash that makes you feel secure, proud, responsible. But what if I told you that keeping too much money in your bank account might actually be one of the worst financial decisions you're making right now? What if that safety net you think you're building is actually a financial trap that's quietly stealing your wealth while you sleep? Most people would call me crazy for saying there's such a thing as having too much cash in the bank. We've been conditioned to believe that cash is king, that a big savings account equals financial security. But here's the uncomfortable truth your bank definitely doesn't want you to know. Every single day that your money sits in that account, it's losing value. Not a little, enough to wreck your future. I'm Hamster. I spend way too much time thinking about money, inflation, and why most people's financial strategies are completely backwards. If you actually want to understand how money works, instead of just hoping everything will magically work out, hit subscribe and give this video a thumbs up. Because by the end, you'll know exactly how much cash you should keep and what to do with the rest before it evaporates. But before we dive into the numbers, let me ask you something. How did you decide how much money to keep in your bank account? Did you calculate your living expenses and multiply by 6? Or did you just let it accumulate, feeling a little safer with every extra thousand? If you're like most people, it's the second one, and that's the problem. Let's start with the math. Inflation is the silent killer of cash. The Federal Reserve targets 2% annually, but we all know it's often higher. In recent years, we've seen 3%, 5%, even 9% spikes. Let's use a conservative 2.5% for our examples. If you have $10,000 in a typical savings account earning 0.5% interest, your real return is negative 2% per year. After 1 year, that $10,000 buys what $9,800 bought before. Not a disaster, but it's a loss. Now let's stretch that over a decade. The same $10,000 eroded by 2% annually will have the purchasing power of about $8,200. You've lost almost a fifth of your money without spending a cent. But numbers on a screen can feel abstract. Let's make it real. A Chipotle burrito that cost $8 a few years ago now runs you $12. A new car that was $38,000 is now pushing $48,000. Rent in many cities has doubled in the last decade. Healthcare costs have outpaced inflation for years. The money in your checking account is melting like ice in a hot sun. And here's the kicker. The higher your cash balance, the bigger the absolute loss. If you have $50,000 in a low-interest account, you're losing about $1,000 a year in purchasing power. If you have $100,000, you're losing $2,000 a year. That's a vacation, that's a car payment, that's money you're giving away to nobody. It's just gone. Let's put it in perspective. Over a 30-year career, if you keep an extra $30,000 in cash instead of investing it, you're not just losing the inflation hit, you're losing the growth that money could have generated. We'll get to that in a moment. But inflation is only half the story. The real killer is what I call opportunity cost. Every dollar that sits in a low-interest account isn't just losing value, it's missing out on the chance to grow. Let's run a realistic example. You have $50,000 in the bank, but your true emergency fund need is only $20,000. That extra $30,000, if invested in a simple, diversified portfolio, could grow at historically average rates of about 7% per year. In 10 years, that $30,000 becomes nearly $59,000. In 20 years, it's $116,000. In 30 years, it's over $228,000. That's not magic. That's compound interest, and it's the single most reliable way to build wealth. Now, what if you leave that $30,000 in your savings account? After a decade earning maybe 0.5%, you'd have about $31,500. You've cost yourself nearly $30,000 of potential growth just by playing it safe. That's not safe. That's expensive. Let's make it personal. Imagine you're 30 years old. You have $30,000 in excess cash. If you invest it and never add another dollar, by age 65 it could be worth over $300,000 at 7% growth. That's a potential retirement boost of hundreds of thousands of dollars. If you leave it in cash, you'll have maybe $35,000. Which version of your 65-year-old self do you want to be? Now, let's take it a step further. What if you not only invest that excess cash, but also add to it over time? The numbers become staggering. This is why I keep saying cash is for liquidity, not for long-term growth. This is the part where I give you a simple, actionable number. Financial experts generally agree you should keep 3 to 6 months of your actual living expenses in a readily accessible savings account. Notice I said living expenses, not income. If your monthly essentials, rent, utilities, groceries, insurance, minimum debt payments total $3,300, then your emergency fund should be between $9,900 and $19,800. That's it. Anything above that is excess cash. But here's where people mess up. They look at their income instead of their expenses, or they convince themselves they need a year's worth just in case the world ends. That's not prudence, it's anxiety dressed up as responsibility. Let's get real. If you're single, have a stable job, no dependents, you're probably fine with 3 months. If you're a freelancer with variable income, a mortgage, and kids, aim for 6. The key is being honest about your actual needs, not your imaginary fears. Everything beyond that 3 to 6 month buffer is excess cash, and excess cash is a liability, a sleeping asset that's slowly losing value. Now let's talk about what living expenses actually includes. It's not your total spending. It's the bare minimum you need to survive. Housing, food, utilities, transportation, insurance, and minimum debt payments. It does not include your Netflix subscription, dining out, or gym membership. If an emergency happens, you can cut those. Calculate that number carefully. It's the foundation of your emergency fund. Now let's talk about why we hoard cash. It's not about math, it's about feelings. Cash in the bank feels safe. You can see it. It doesn't go up and down. It doesn't make you nervous when the news says markets tumble. For many people, a big bank balance is a security blanket, a tangible proof that they've made it. But here's the problem. That security blanket is made of money that's slowly losing value. You're paying for comfort with your future wealth. I've seen people with 6-figure bank accounts terrified to invest a single dollar. They've worked so hard to save and they're so afraid of losing it that they guarantee they'll lose it, slowly, to inflation and missed opportunities. Let's unpack that fear. People imagine worst-case scenarios. The market crashes, they lose their job, they need cash, and their investments are down 50%. They think, if I had kept it in cash, I'd be fine. But how often does that perfect storm actually happen? Even if it does, you still have your 6-month emergency fund, you have unemployment benefits, you have options. Meanwhile, the guarantee that you're losing purchasing power happens every single day. The real risk isn't the market crashing. The real risk is your money slowly decaying year after year while you feel safe. I want to introduce a concept called financial false security. It's when you feel secure because of a large cash balance, but that security is an illusion because your wealth is actually shrinking. True security comes from having assets that grow faster than inflation, plus enough liquid cash to handle short-term shocks. Okay, so you've identified your excess cash. Now what? Here are 3 powerful places to put it, each with its own risk and reward profile. Let's go deep. Bucket 1. Invest in low-cost index funds. This isn't day trading or stock picking. It's buying a tiny slice of thousands of companies and letting capitalism do what it does best. Historically, the S&P 500 has returned about 7 to 10% annually over long periods. Even after inflation, you're far ahead of cash. But Hamster, what about volatility? Yeah, it goes down sometimes, but if you have a long horizon, 5, 10, 20 years, the trend is your friend. And remember, you still have your emergency fund for short-term needs. Let's break down the different types of index funds. You have total stock market funds, S&P 500 funds, international funds, bond funds. For most people, a simple target date retirement fund is the easiest. It automatically rebalances and adjusts risk as you get closer to retirement. Bucket 2. Consider real estate. If you have enough for a down payment, rental properties can provide cash flow and appreciation. Or you can invest in REITs, real estate investment trusts, that pay dividends. Real estate often keeps pace with inflation because rents and property values rise with prices. But real estate requires more capital and isn't as liquid. It's not for everyone. If you go this route, do your homework. Location matters, tenant selection matters, and you need to be prepared for maintenance costs. Bucket 3. Invest in yourself. This is the highest return investment you can make. That $20,000 sitting idle could pay for a certification, a course, or the startup costs for a side business. A new skill that boosts your income by $10,000 a year has an infinite return on investment. Examples: a PMP certification, a coding boot camp, a real estate license, a marketing certificate, or even just a year of career coaching. The skills you gain can compound your earning power for decades. I'm not saying you should throw your money at the first hot stock you see, but I am saying you should stop treating your savings account as your primary wealth building tool. It's a tool for liquidity, not for growth. Now let's get practical. Here's a step-by-step plan to get your cash working for you. Follow these steps in order. Step 1. Calculate your true monthly living expenses. Not your income, not your maybe I'll buy this expenses. Rent, utilities, food, insurance, minimum debt payments, that's it. If you're not sure, look at 3 months of bank statements, use a spreadsheet or a budgeting app. Step 2. Multiply that number by 3 and by 6. That's your emergency fund range. Choose where you fall based on your job stability, family situation, and personal comfort. If you're self-employed, lean towards 6. If you have a stable government job, 3 might be fine. Step 3. Identify your excess cash. Anything above that number is available for investing. Step 4. Don't dump it all at once. If you're nervous, invest 25% of the excess each month over 4 months. That's called dollar cost averaging. It smooths out the anxiety and reduces the risk of investing right before a dip. Step 5. Choose your investment vehicle. For most people, a low-cost index fund like VTI, VOO, or a target date retirement fund is the simplest, most effective choice. If you want to diversify, consider a mix of stocks, bonds, and maybe a REIT. Step 6. Automate it. Set up automatic transfers to a brokerage account. When you don't see the money, you don't miss it. Make it as automatic as your rent payment. Step 7. Stop checking your balance obsessively. Your bank account is not your scoreboard. Your net worth is. Watch your net worth grow over time, not your checking account shrink in the short term. Step 8. Review and rebalance annually. Once a year, check your portfolio. If one asset class has grown a lot, consider selling some and buying others to maintain your desired risk level. Step 9. Don't forget tax-advantaged accounts. Before investing in a taxable brokerage, max out your IRA, 401k, and HSA if you can. Those accounts offer tax benefits that supercharge your returns. I know there are voices in your head saying, but Hamster, what about... So let's address the biggest objections head on, one by one. Objection 1. What if the market crashes right after I invest? Then you buy more. Seriously. If you're investing for the long term, a crash is a sale. Your monthly contributions buy more shares. The people who panic and sell are the ones who lose. The people who stay the course end up ahead. In fact, the biggest gains often come right after the deepest dips. Objection 2. I might need the money for a house down payment soon. That's a legitimate reason to keep cash, but if soon means 3 to 5 years, consider a high-yield savings account or short-term bonds. If soon is vague, ask yourself, are you really going to buy that house, or are you using it as an excuse to avoid investing? Be honest. Objection 3. I have a low risk tolerance. That's okay. You don't have to go all in on stocks. You can keep a larger emergency fund, say 8 to 12 months, and invest the rest in a balanced portfolio, or use a target date fund that automatically adjusts risk as you age. The key is to stop leaving all your money in a guaranteed loss account. Objection 4. My parents always told me cash is safe. They were right, for their generation. But times have changed, interest rates are low, inflation is higher, and life expectancy is longer. What was safe then is risky now. It's not about disrespecting their advice, it's about adapting to today's economy. Objection 5. I don't understand investing. That's fine. You don't need to be an expert. You can start with a simple target date fund. It's designed for people who don't want to manage their own investments. Just pick the year you plan to retire, and the fund does the rest. Objection 6. What if I lose my job and the market is down? That's why you have an emergency fund. 6 months of expenses gives you plenty of time to find another job without touching your investments. If the job loss happens during a market downturn, you can leave your investments untouched and let them recover. Let me tell you about 4 people I know. Names changed, but the stories are real. Sarah was a graphic designer. She saved religiously for 15 years, accumulating $120,000 in a savings account. She felt proud, safe. When she asked me what to do, she was terrified of the stock market. I suggested she move $80,000 into a balanced portfolio, keeping $40,000 as an emergency fund. She said she'd think about it. 5 years later, her $80,000 would have grown to about $112,000, 7% average. Instead, it earned maybe 1%, about $84,000. She lost $28,000 in potential growth. That's a car, that's a year of college tuition. Mike was a teacher. He had $30,000 in a savings account. He was nervous, but he followed the plan, kept $15,000 as an emergency fund, invested the other $15,000 in a low-cost index fund. 10 years later, that $15,000 had grown to over $30,000. He told me, "I wish I'd done it sooner." But he didn't regret starting. Elena was a nurse. She had $80,000 in cash. She was planning to buy a house someday. When I asked her timeline, she admitted it was vague. We moved $50,000 into a balanced portfolio. 3 years later, the market had grown, and she used $40,000 for a down payment, still leaving her with more than if she'd left it all in cash. David was a freelancer with variable income. He kept $50,000 in cash because he was scared of dry spells. We calculated his true living expenses at $3,500 per month. He kept $25,000 as an emergency fund about 7 months and invested the rest. 4 years later, his investments had grown to $45,000 and he had never touched his emergency fund. The difference between these stories? The ones who took action built wealth. The ones who let fear win missed out. Here's the biggest change you'll notice once you start deploying your cash. Your whole relationship with money transforms. A saver asks, "How much can I save?" They feel proud of their bank balance. They're focused on accumulation. An investor asks, "How much wealth can I create?" They feel excited about their net worth growth. They're focused on productivity of capital. This shift isn't just about returns, it's about identity. Once you see yourself as someone who makes money work, you stop being paralyzed by fear. You start looking for opportunities. You become more intentional with every dollar. You'll also notice that you become more intentional with spending. When your cash is lean, you're less likely to blow it on random stuff. Parkinson's law says expenses expand to fill available income. The same goes for cash. Keep too much and you'll find excuses to spend it. The wealthy understand this. They keep enough for immediate needs and opportunities, but everything else is working for them. They know that cash flow is more important than cash accumulation. Let me give you a personal example. When I first started investing, I kept a large cash cushion because I was scared. But after a few years, I realized that the money I had invested was growing faster than I could save. That gave me the confidence to reduce my cash cushion and invest more. Now I sleep better knowing my wealth is growing, not shrinking. If you've already deployed your excess cash, congratulations. You're ahead of 90% of people. But there's more you can do to optimize. Tax-advantaged accounts. If you're investing in a taxable brokerage account, consider whether you've maxed out your IRA, 401k, or HSA first. Those accounts offer tax benefits that can supercharge your returns. For 2025, the IRA limit is $7,000, $8,000 if over 50. The 401k limit is $23,500, $31,000 if over 50. The HSA limit is $4,300 for individuals, $8,550 for families. Diversify across asset classes. Don't put everything in U.S. stocks. Consider international stocks, bonds, real estate, and even a small allocation to alternatives if you're comfortable. A simple 3-fund portfolio, U.S. stocks, international stocks, bonds, is a great start. Rebalance annually. Over time, your investments will grow at different rates. Once a year, sell some winners and buy some laggards to keep your risk level where you want it. This forces you to buy low and sell high. Set up a cash flow account. Instead of keeping all your cash in one place, create a separate account for upcoming expenses, vacations, big purchases. That way, your emergency fund stays pure and you don't accidentally dip into it. Consider a financial advisor. If your portfolio grows to 6 figures and you feel overwhelmed, a fee-only advisor can help you stay disciplined. Look for someone who charges by the hour or a flat fee, not a percentage of assets. Automate your investments, already covered, but worth repeating. When you automate, you remove emotion from the equation. Avoid market timing. Don't try to predict when the market will go up or down. Even professionals get it wrong. Instead, invest consistently over time. Sometimes you come into a large sum of money, an inheritance, a bonus, selling a business. What do you do then? The same principles apply, but you have to be extra careful because emotions run high. First, park it. Don't rush. Put the money in a high-yield savings account or a short-term CD while you decide. Second, update your emergency fund. If you didn't have a full 3 to 6 month fund, fill it now. Third, pay off high-interest debt. If you have credit card debt or personal loans above 6 to 8%, kill them. That's a guaranteed return. Fourth, invest the rest. Use the same dollar cost averaging approach. If it's a very large sum, consider investing over 6 to 12 months to smooth out the anxiety. Fifth, treat yourself a little. Set aside a small percentage, maybe 5%, for something you'll enjoy. This isn't about being frivolous, it's about acknowledging the windfall and making the process feel positive. You don't have to do this alone. In fact, having a support system can make the difference between staying on track and falling back into old habits. Find an accountability partner. This could be a spouse, a close friend, or a family member. Share your goals and check in regularly. Join a community. There are many online groups focused on financial independence, investing, and wealth building. Surround yourself with people who are doing what you want to do. Consider working with a fee-only financial planner. They can help you create a comprehensive plan, not just for investing, but for taxes, insurance, and estate planning. Look for someone with a CFP designation. Automate as much as possible. We've said it before, but it's worth repeating. Automation removes the need for willpower. Celebrate milestones. When you hit your first $10,000 invested or $50,000 or $100,000, celebrate. Not with a spending spree, but with a small, meaningful reward. Acknowledge your progress. So here's the bottom line. You should keep 3 to 6 months of living expenses in your bank account. Everything above that is excess cash that should be put to work before inflation eats it, before opportunity cost steals your future, before fear keeps you stuck. The bank loves it when you hoard cash. They take your money, lend it out at 7 to 10%, and give you back 0.5%. You're subsidizing their profits with your anxiety. Don't let them. Your money should work as hard as you do. If this video shifted how you think about your savings, hit that subscribe button. Share it with someone who's sitting on a pile of cash scared to move, because the sooner they understand this, the sooner their money starts building real wealth. I'm Hamster. Go make your money work.